Good evening, or good afternoon, or good morning, depending on where you're joining us from today. I just wanted to welcome you and say thank you for joining us for the launch of the Toxic Bonds Initiative. My name is Nick Haynes. I'm based in Melbourne, Australia, on the unceded land of the Wurundjeri people. I'm from Some of Us. We're a global organisation of 20 million members across the world committed to holding powerful companies accountable, and we are proud to be coordinating the Toxic Bonds Initiative. For that reason, it's also my pleasure to get to welcome you today and introduce the session. So I'm just going to quickly run through how today is going to work. I'm thinking there'll still be some people joining over the first few minutes, which is fine. So we'll just go a quick overview of how today's going to work. First, we'll start with an introduction from me to Toxic Bonds, a brief overview of the project and the topics we'll be covering today. We're then going to dive right into a panel discussion moderated by Natasha White, and we'll delve much deeper into the details there of bonds and bond market campaigning. We'll then have, throughout that discussion, panelists will be introduced two at a time, and there'll be opportunities after the first two panelists are introduced for questions, and then the second two panelists for questions also. We'll then have a broader Q&A discussion with everyone on the panel to close out the remainder of the end of the session. For that reason, if at any point during the session you have questions, please type them as they come to you. You can do so in the chat and or on Twitter. And my colleagues Nanita and Alice will be there monitoring those chat windows, and we'll make sure your questions are being fed through. So if at any point during the session the question comes up, feel free to type it at the time, and we'll get picked up in the Q&A sessions. One request also is, if possible, it'd be great if you could add your name and organisation when running a question in the chat. So why are we here talking about corporate bonds? In short, because bonds are a critical source of finance for new coal, oil and gas. Right now, total global bond issuance is at a decade high. And by issuing bonds, companies can often borrow much larger sums with lower interest rates and have fewer restrictions than bank loans. We're seeing right now, thanks to the work of many in civil society and elsewhere, that there's some tightening of lending and investment policies, particularly facing coal. But the bond market remains an open doorway for these companies to fund expansionary projects. So let's take a look at some of the numbers. Coal companies with the biggest expansion plans raise more than 2.5 times more capital through bond issuance than bank loans, according to analysis by the Sunrise Project. And if we look at the top 20 companies with the largest historic emissions, we see that of almost $1 trillion in debt financing, 69% of it is being financed through bonds, according to the Climate Accountability Institute. And even while not facing the same pressures on lending that there is in coal, we're seeing the oil and gas industry has issued more than $2 trillion of bonds since the Paris Climate Agreement was signed. And of that $2 trillion, more than $600 billion is set to mature after 2030. So why are we not seeing the same volume of engagement from civil society and campaigning organisations around the bond markets? I think there are a few reasons why. There's some big challenges to campaigning around bonds. And the first is timing. The time between when a new bond is announced and when it's fully subscribed in the market is often only a matter of days. So there's a very short window of time in which to engage investors in the market around a new bond. We also see big information gaps. The bond market is intrinsically more opaque and with lower disclosure requirements than the global equities market. And so the availability of data and information we have to act on is considerably lower. And all of these challenges require a coordinated approach. And I think one of the best ways to overcome these is through coordination among civil society. Which brings us to the Toxic Bonds Initiative. The Toxic Bonds Initiative brings together civil society organisations from across the world to help draw attention to the role the bond market plays in fueling the climate crisis. we are seeking to address some of those key challenges mentioned earlier, addressing the information gap. So you'll see here a screen grab from the website where we are compiling all of the outstanding bond issuances of what we're calling the Dirty 30 top bond issuing fossil fuel expansionary companies. And I'll get into more detail in a second about who those companies are. But we're bringing together that detail, that information on outstanding US dollar and euro bonds and helping civil society track those as they reach maturity. We're also consolidating the campaigns and shining of being run by civil society across the world, targeting bond market activity. And so shining a spotlight on those and helping amplify voices from different corners of the globe as they tackle bond market participants. And finally, sharing resources and information so that there is, again, addressing some of that information gap we experience when trying to find data and resources around the bond market. And so this is important not only for civil society, but also for media and the investor community also. So the Dirty 30, these are some of the top bond issuing expansionary fossil fuel companies in the world. These are companies who all have plans to expand coal, oil, and gas operations, and they're using the bond market to do it. So we've identified this top 30 list, and on toxicbonds.org, you can see all of the outstanding US dollar and euro bonds those companies currently have outstanding. And so over time, we will continue to monitor new bond issuances by those companies and run campaigns to disrupt those bond issuances as they occur. Of the Dirty 30 company, they have more than $491 billion in outstanding US dollar and euro bonds. That's a lot of capital in the market. It's a lot of opportunities to campaign, and which brings us to today, the launch of this initiative and the very first steps we take as the Toxic Bonds Initiative. And what this opportunity gives us is, and what this webinar I hope will present is a chance for it's for broader civil society to see the opportunities that campaigning around bond markets could hold, and hopefully we bring together new partnerships to do that. So if you're interested in learning more, and I said this is a very quick overview into toxic bonds, and we're happy to delve into it in a lot more detail in the Q&A session. But if you're interested in becoming more involved, the website is now live. We'll be updating that frequently. Reach out to us at toxicbonds@someofus.org if you're interested in joining the coalition of organizations who are already taking part. And now, to delve into it in a little bit more detail, I want to welcome Natasha White, a reporter from Bloomberg, who's going to be helping moderate the discussion. Welcome, Natasha.
Thanks, Nick. That was a great overview of the initiative, and hi, everyone. I'm really excited to be here today to moderate what is set to be a fascinating discussion on an undercovered topic. As Nick said, I'm an ESG reporter at Bloomberg News in London, and I cover all things related to environment, social, and governance investing. We follow the money, we track emerging norms and regulations, and we try to root out greenwashing where we see it. I joined Bloomberg just over 3 months ago and have covered carbon offsetting, emerging climate science, fossil fuel finance mechanisms, and various corners of the booming ESG market. So first up today, we'll hear from Christina Ung and Lara Cuvelier. Christina and Lara will give us a bird's eye view of the topic before we turn to Dongjae and Pablo, who will share insights and lessons from the specific campaigns they've worked on in this field. Christina Ung is Research and Stakeholder Engagement Leader for Debt Markets at the Institute for Energy, Economics and Financial Analysis, a think tank. Here, she oversees a team of financial analysts that provide debt market analysis of the energy sector in the Asia-Pacific region. Previously, she advised various stakeholders on the adoption and interpretation of standards in international financial reporting. Lara Cuvelier is Sustainable Investment Campaigner at the Paris-based nonprofit Reclaim Finance. Her work focuses on supporting sustainable investment development in the asset owner and asset management sectors. She is the lead author of the recently published Asset Manager Climate Scorecard. Previously, she worked in EY's finance sector sustainability and CSR teams and at Quos Invest, where she helped develop a social impact bond. So, Christina, start us from the beginning. What are bonds and what function do they play in the global market?
Right, thanks, Natasha. So bond issuance is one of the ways to get finance if the company doesn't want to offer shares to the company, or if the bank is unable to provide the full sum or the term that is requested. Much like a bank loan, when a company issues a bond, it receives funds upfront and is then required to pay the bond investors interest over the bond's life. At the maturity of the bond, the company or the issuer must repay the upfront capital and the remaining interest. I would say traditionally, bond investors have not been able to intervene in what the company does. The bond contract just hasn't provided bond investors those rights, unless, of course, the company defaults on its payments. And so as long as the company is able to meet its payments, bondholders don't usually interfere. So this is quite different from equity or shareholders. And it's even quite different for banks who can at least call on the company and have a direct dialogue with the company.
Okay, and why would firms choose to issue bonds rather than raise funds through equity or bank lending?
So I would say, so number one, I think what's really important, I mentioned there's very little interference usually by bond holders, traditionally anyway. So that is a major attraction for why companies would want to issue bonds as compared to going to a bank or to engage with their shareholders. The other thing could be, just the terms of the financing just may not work with the bank. Typically, I think with a bank, you can kind of stretch your financing to up to 7 years. But depending on the market, it can vary. The maximum you could probably get a loan for is 5 years. So the bond market and the bond terms for corporate bonds anyway can be a lot more longer. Some stretch to 10 or maybe even 15 years. Some maybe even longer, but rare. But still, that extended term of financing is actually quite attractive.
Okay, and this initiative is going to focus on the oil, gas, and coal sectors. Just how important are bonds to companies in the energy sector specifically? And are there any particular trends you're observing at the moment?
So I think Nick has already mentioned some of this, but there is strong research that show coal companies with the largest expansion plans raise something like 2.5 times more capital through bond issuance than bank loans. And research also found that almost every coal power company have issued bonds, while only about 75% of them borrow from a bank. So this shows the importance of bond markets to the coal industry. And I think it could be even more important going forward as more banks withdraw from financing coal projects. Trends. I think the issue we're seeing on the rise with bonds is greenwashing. I think it's well known that many energy companies or power utility companies are issuing green bonds. And money raised from these bonds are meant to be allocated to green projects, like solar, wind projects. However, while these companies have intention of issuing bonds for the purpose of raising their renewable energy capacity, many of them are still spending on fossil fuel power projects. So, and this is the case seen in South Korea, China, and India's state-owned power companies. Having said that, we're also seeing experienced ESG investors asking questions about the company's phase-out or transition plans, about fossil fuel projects that the company proposed or are still in the pipeline. So, and some of these investors have even called out the greenwashing and have declined to invest in bonds of companies that do not have such plans in place. So I think this kind of dialogue and calling out the greenwash does show that the traditional engagement between bond issuer and investor is changing. So it will be interesting to see how this plays out.
Mm. Okay, thanks. And you've written extensively on green bond taxonomies, and you touched there on green bonds and issues of greenwashing. What is your take on these? Are they the future of sustainable investing? Are they going to help channel finance to more sustainable channels?
Trick question. So green bond taxonomies, in theory, they should be facilitating the mobilization of green capital to green projects that are backed by science to be environmentally friendly. But unfortunately, I think we're already seeing, in some markets, the lobbying, oil and gas lobbying is quite strong. So much so that some taxonomies have been watered down and have incorporated, projects like gas and to be called or to be given the green label. So I think with all policy frameworks, what really is important now is to enforce better regulations of these taxonomies. And I think clearer guidance on implementation of how the green bond taxonomy should be used should be a focus for us to really get the real benefits of green bond taxonomies.
Okay, thank you. And coming back to your previous point around engagement, particularly from ESG investors, a lot of your work is focused on the energy sector in Asia. And one aspect that sets this market apart from others is the prevalence of the big players being state-owned or heavily backed by the state. And how does this aspect influence how these companies can be engaged by investors?
I think unless there is evidence that the government is unlikely to bail out these state-owned companies at times of default, for example, or financial difficulties. In the eyes of debt investors, these companies are going to be seen as attractive investment. So, but ESG debt investors, I've seen some of them have applied kind of like in-house lens, right? Like a test on their investment decisions. So, for example, there are some asset managers who are applying a test where if the government doesn't have a good track record on climate action or human rights practices, then that could affect their investment decision. So I think that's something that could be considered. Also, when it comes to matters that are state-owned, state-linked entities, I think influencing and shaping the policy decisions quite early on could be effective in making whole market transformation changes.
Okay, thank you. We're going to turn now to hear from Lara before we take any questions from the audience. Lara, Christina just mentioned the key role or an important role of asset managers as stakeholders, and you recently published a report on asset managers and climate change. What did this report uncover?
Thank you, Natasha. So what our report revealed is that despite the calls by climate scientists to immediately start decreasing the overall fossil fuel production, big asset managers are still investing billions into companies whose fossil fuel expansion plans make this objective actually impossible to achieve. And the starting point of our research was that a growing number of asset managers are actually pushing back against adopting exclusion criteria for their portfolios, arguing that engagement is more useful to support the transition of companies towards net zero world. And yet what we found with this report is that almost none of them have adopted the policies to make engagement meaningful. For example, when they have a voice, so at AGMs, but also during bond capital rounds, they do not ask fossil fuel companies to stop opening new oil and gas fields. And what's worse, it's that it's quite the opposite, actually. And that's not only do they not make the end of fossil fuel expansion the backbone of their engagement strategy, but they keep pouring new capital into companies that are crossing the red line that was drawn by the IEA in its net zero roadmap. So that is, there is no room in our carbon budget for new coal projects or for new oil and gas fields. And here I'm not talking about maintaining the existing investments into fossil fuel expansionists, but about new capital, so fresh money that is given to fossil fuel companies, and that helps them to open these new fields. And with this report, more concretely, we also analyzed in depth their policies, their asset manager policies, to understand if there were restrictions regarding both new investments in shares and bonds, but also planned divestments. And what's striking is that today, only 7 out of the 30 asset managers we assessed have policies that say that they commit to not buying new bonds of coal developers, and 0 had those policies for the oil and gas sector. And concretely, this means that they're big providers of new debt to fossil fuel expansionists. And this matters for 2 main reasons, and that's also why we think that this toxic bond campaign is really going to be crucial, is that because for these companies, these fossil fuel companies, bonds, as Nick was saying, are a critical source of funding. We know that the companies on the global oil and gas exit list had over 9,000 bonds on the market in 2020, and that banks are less and less willing to provide loans to these companies. So they are increasingly raising capital via bond issuance. And the second reason is that when asset managers and investors hold bonds, it gives them power. So not by voting in AGMs like they do if they hold shares, but by using capital rounds. So where companies are more vulnerable and actually beg for cash to weigh in on their plans. And the primary market is actually easier to access than for equities because companies regularly issue bonds to finance their operations and develop them. So that's some of the main findings. And I think overall investors, what we found is that they will not live up to their climate commitments to be net zero unless they restrict investments with fossil fuel developers. And to finish on a more positive note, we do see some investors, when we analyze their policies, that are taking the right steps. For example, CNP, a French investor, that recently published a policy saying they were keeping their holdings to engage fossil fuel companies, but that they won't make new investments, so including bonds, if fossil fuel expansion is still happening. So we hope that others will follow and that it's going into the right direction.
Thanks. And you touched on a couple of names there, but who are the biggest bondholders of these fossil fuel firms, and what are your specific recommendations for them? Again, touched on their policies, but more broadly.
So in this report, we looked at two groups of companies. So first we looked at the companies that were still developing new coal projects, so new coal mines or plants. And here, among the 30 big asset managers we analyzed, we could find BlackRock or Vanguard or Allianz, for example, among the biggest bondholders of these coal expansionists. The three same, actually, and Amundi were among the biggest bondholders for the second group, which were oil and gas expansionists. So here we selected 12 major oil and gas companies that were behind most of the upstream expansion plans that we see currently. So this is in terms of examples of biggest bondholders. We also give examples in this report of two bonds that were issued recently by Pemex and Saudi Aramco. And here we also find that some of the asset managers we analyzed were among the investors that bought these new bonds. So for example, BlackRock was there, also Schroders or Natixis, which is a French investor. So that's for the trends that we saw. And then maybe on what our conclusion is in the report and what for us asset managers should be implementing in their policies is first to deny new debt to all fossil fuel expansionists and have this as a clear red line. And then to set in their engagement policies the clear expectation that companies should stop expansion and start decreasing overall fossil fuel production now. With a very clear deadline to divest at some point if companies fail to comply. And this is where discussions during capital rounds make sense. And yeah, net zero committed asset managers specifically should go further actually and commit to no longer buy bonds from companies that do not have binding covenants that set out like serious, credible net zero action plans that are consistent with the lifetime of the bond.
Okay, thank you. And in Christina spoke about the sustainability, the ESG market. Just last year, Total, which is a company that you've written about, Total Energies, announced that it would only issue sustainability-linked bonds into the future, and Reclaim Finance has criticised this plan. So kind of, yeah, building on what you've just explained to us there, why are these sustainability-linked bonds problematic?
So last year we criticized this announcement that Total would issue new bonds because mainly Total Energy doesn't have a proper plan to transition. Its strategy currently isn't 1.5 degree aligned, and actually many investors recognize this. And that for us, Total Energy announcing that they will only now issue sustainable debt for us is kind of a trap for investors because they're actually these bonds would actually help finance their fossil fuel expansion plans. So if investors would buy the bond, they would be actually validating Total Energy's plans for 5 or 10 years, depending on the maturity of the bond, while the plan is far from ambitious enough. And we know that, for example, more than 70% of Total's capex will be dedicated to fossil fuels, even in the coming years. And that is still planning on developing massively new oil and gas projects. So these are basically the reason for which we called out on investors not to buy the bonds. And to finish, so the end of this story was that Total did issue a new bond in January, but not labeled as sustainable. And it was bought right away anyway. So yeah, this also raises the questions of the fact that fossil fuel companies actually don't have problems currently raising capital at all, even if they're not labeled as sustainable.
Okay, thank you. I think we'll turn now to any questions from the audience before we move on to the next two panelists. Do we have any questions from the audience?
I just had a question, actually, just to pick up on what you were saying, Lara and Christina, like in terms of the differences between sustainability-linked bonds and green bonds. Could you just go into that slightly, into how they differ?
Yep, sure. I can start off and I'll let Lara pick it up. So with green bonds, I might have mentioned already earlier that the issuers are meant to be allocating proceeds from green bonds only to green projects. So they are project-specific bonds, whereas sustainability-linked bonds do not have that project-specific use of proceeds. Instead, what it requires is issuers, so the company, to have a few targets in terms of what how would you? I think some of the common targets that we're seeing, at least in the energy companies, are things like lowering greenhouse gas emissions by a certain time, by a certain percentage. Another target that we're seeing is something like increasing the renewable energy capacity by a certain percentage by a certain time. So, but the problem, and I think this is where Lara was, has talked about the criticism, is the sustainability-linked bonds, because they're not green project specific. It can actually be used to finance anything the corporate, the company would like to. So the decisions are really up to them in terms of how they use that money, as long as they meet those targets. And I would add that, and I think this supplements what Lara's already commented. There are many ESG investors, or at least the lead pack, the serious ESG investors, who have actually come out strong against sustainability-linked bonds, because it doesn't provide them the certainty in where the proceeds are going to. And so that's quite an important thing to note. And that's why I think many companies that are planning or or have issued sustainability-linked bonds have actually been criticized quite heavily. And I wouldn't say it's just Total.
Great. Thanks, Christina. So we've got some questions coming in from the audience. The first is from Aaron Illeri. Could you say more about the trend to issue bonds versus loans? How much of the financing for fossil fuel companies comes from bonds versus loans? And is the trend towards bonds similar across regions, or is there some kind of geographic disparity? And I think that's probably one for you, Christina, but other panelists, feel free to jump in.
So I think in terms of whether the trend is similar across the region, there was a study that was done that looked at the larger companies with fossil fuel expansion plans. And those companies, I think they covered something like China, state-owned entities, India, Indonesia, South Korea. So it's quite a wide range of companies globally, but a lot of them were focused on in Asia. In terms of the trend on issuing bonds versus bank loans, what that research has also shown is that the issuers have actually gone to market raising bonds 2.5 times more capital than going to a bank and getting a bank loan. So, and that's quite consistent across many of the companies that were studied in that research.
Okay, thank you. We've got another question now from Nishant at Environics. what is the role of central banks and corporates' quantitative easing in supporting toxic bonds? Is the ECB, so the European Central Bank's climate roadmap, in line with the Paris Agreement? And Christina, I think that's probably one for you as well, although Lara, maybe you want to jump in.
Well, I'll let Lara take this one.
And maybe if I can very quickly add something on the previous question,
Of course.
and then trying to answer this one. So very quickly, I think one interesting stat that came out from some of the EIA data is that the vast majority, I think it was about 90% of the fossil fuel projects currently are now financed via companies' balance sheets and not via project financing. And what's interesting also that we see also in discussions with banks or in reports, and that banks now assess that it's riskier to give loans to fossil fuel companies because it appears on their balance sheets, whereas when they underwrite, it's not. It's a more indirect way for them to keep helping the company to raise capital, but indirectly. And often we also see asset managers being arms of bigger groups of big banks that are also involved in buying these newly issued bonds. So kind of a win-win situation here. Thing I wanted to highlight. And then for central banks, I mean, for here I will have a general answer, but definitely central banks can have important influence and a lot of influence and here in how they act towards fossil fuel companies and the requirements they're asking to them. And we see ECB's climate roadmap making progress, but not still having very strong requirements for companies to be in line with the Paris Agreement.
Okay, thank you. And would anyone else like to feed into that question or the previous? Any other panelists? Okay, so there's another question with a few elements, and I'll open it up to all panelists, but feel free to take any aspect. So can you talk a bit on bank guarantees to miners, for example, surrounding coal auctions in India? Are these issued irrespective of any climate considerations? That's the first part of the question. And the second part of the question is how does ESG investing typically differ from impact investing? Would anyone like to tackle either part of that question, those questions? Okay, so we'll move on. Oh, go ahead,
Maybe
Lara.
a very quick answer on the part on ESG investing compared to impact investing, if I understood it well. So basically, ESG investing would be much broader and actually a lot more confusing because there's no standard definition of what is ESG, but it's basically a financial institution can say that it's doing ESG investing or financing as long as it's taking into account environmental or social or government aspects in the way it's taking its investment or financing decisions. So it basically can be simply having an ESG rate for each of the companies it's going to put in its funds, for example, to going a bit more further and say we'll exclude companies that have a very low ESG rating. And the problem with ESG investing is that we're still lacking standards. So it really depends on what each financial institution is, how it's defining and what it's putting behind ESG. And impact investing is more in terms of trying that if you're an asset manager, that your fund will actually have an impact and have an environmental objective, for example. So here it's more about really trying to show the additionality of your investment or financing and how it's actually benefiting an environmental or social aspect, and trying to go a bit further.
Okay, thanks, Lara. There are a few more questions, but I think we'll take them at the end. So we'll move on now. Next up, we have Dongjae Oh and Pablo Brait. Dongjae is researcher at Solutions for Our Climate, a Seoul-based nonprofit, where he leads campaigns relating to fossil fuel finance and upstream gas in particular. He attended the 2018 UN climate negotiations as a student observer and is currently on the steering committee of Big Wave, a youth climate change network. Previously, he was guest reporter at the Environment Daily Times. Pablo is a campaigner with Market Forces, an Australian nonprofit and affiliate of Friends of the Earth Australia. Here, his work focuses on shifting finance and other types of support away from environmentally damaging projects to those that protect and enhance the environment and climate. Pablo works on the Stopadani movement, one of the largest environmental campaigns in Australian history, which he'll talk about shortly. So Dongjae, let's start with you. Please, could you tell us more about the Samchuk Blue Power project and how it features in this picture of the Toxic Bonds Initiative? What was this campaign about, and why were bondholders relevant to this work?
Yeah, thank you, Natasha, for the introduction, and I'm also honored to be here and excited to share SFOC and our domestic partner CSO's bond campaign experienced against the Samchuk Blue Power, the country's last coal power project. Before I get into the campaign introduction, I individually want to thank Pablo and the colleagues of Market Forces, because our campaign was deeply inspired by the campaign of the Market Forces with regard to the Carmichael project. So the Samchuk Blue Power was proposed and constructed by SPC from POSCO and partially Doosan Heavy, and it is still being constructed. Our concern was that 2.1 gigawatt Samchuk Blue Power's expected emissions are about to be 13 million tons per year until 2054. Considering Korea's 2050 net zero commitments, the decision to still go forward with the project is deemed as a big contradiction. Unlike other typical project financing cases, Samchuk Blue Power started its construction without fulfilling its project financing. So out of $4.5 billion, they were short of $0.9 billion, which is about 20% of the total finance. For this financial shortages, the Samchuk Blue Power owners, the Samchuk Blue Power owners decided to finance shortages through bond issuance. We launched the Samchuk Bond campaign in December 2020 before the third round of Samchuk Blue Power bond issuance. We sent joint letters to major asset managers in Korea 3 months prior to the expected bond issuance, while sharing both environmental and financial risks of the project. We requested them to get back to us with their decision on boycotting Samchuk Blue Power's bond, which we said we will post publicly on our campaign website. So we gathered responses from asset managers and unveiled it on the website and updated it gradually until now.
Okay, so you've touched a bit about what you heard from the asset managers when you engaged them around this project, but why did they decline to invest in this one, but not others like it?
Yeah. So the campaign's result was really successful in our perspective. As the result of the campaign, 25 asset management companies, which are operating about 90% of the Korean bond market, pledged to not invest in the project. So eventually, Samchuk's consequent bond issuance recorded zero demand from asset management companies. That's a huge victory for us. And consequently, Korean credit rating agencies, including Korea Investors Service, downgraded Samchuk's bond rating from AA minus to A plus. So KIS reasoned the demise of business and financial stability as the main reason for the downgrade of this bond rating. Yeah. In our messaging, we concentrated on the financial risks of the project to the asset managers. So most of our communications were done through the email and a few phone calls. So we do not know in much detail as to which of the factors were most critical to asset managers' consideration. However, we do think with the expansion of ESG movement in Korea over last 2 years and coal divestment commencement trends of financial sector contributed to the success of our campaign. After all, the boycotting the Samcheok bonds could have been a test bed even for the asset management companies, as they have no good reason to invest in projects with high financial and also for the reputational risks.
Okay, thank you. I think we'll move on to Pablo, and we'll come back to you again in the Q&A after. So Pablo, turning now to your campaign against the Adani Carmichael mine. You've secured commitments from over 100 companies and financial institutions not to participate in the project. Why is the bond market relevant to the Stopadani campaign? And could you tell us a bit more about how you engaged bondholders in this work?
Sure. Thanks, Natasha, and thanks, Dongjae. Yeah, so for those that don't know, the Stopadani campaign is a long-running campaign that's working to stop the Carmichael thermal coal project in Australia, which is being constructed and soon to be operated by the Adani Group conglomerate. Pardon me. So we were in a situation on this campaign that by the end of around 2018, we had successfully forced Adani to self-fund the Carmichael project. So what that meant was that we had a list of around 40 to 50 banks who had promised not to lend to it directly, and Adani was just unable to find bank loans to finance the project, and they said they would fund the project. They shrank the project and said, we'll fund it through internal Adani Group funds. So we started looking at the Adani Group more broadly after that, so outside of Australia. And we noticed that some of the banks that had made their commitment not to fund the Carmichael project were arranging bonds for other Adani Group subsidiaries. And we were particularly interested in a subsidiary called Adani Ports and Special Economic Zone, or Adani Ports, which is one of the main Adani subsidiaries, and it had a direct link to the Carmichael project. It established the coal haulage company that is transporting the coal, and it also runs and partly owns the port on the Great Barrier Reef, World Heritage Area, via which the coal will be exported from Australia to India. So there was that direct involvement. So we started looking at that, and the Adani Group really has a highly complex structure. We've had banks tell us that it's the most complex corporate structure they've ever seen. And so when it suits it, it acts like 7 different publicly listed companies and then a range of private entities. Oh no, we have nothing to do with that company, that's a separate company, that sort of thing. And we're seeing it concentrate its coal projects, for example, in Adani Enterprises and Adani Power. But when it suits it, it also acts as one entity with money flowing between the entities, between the different subsidiaries. And obviously that's how Carmichael has been funded, in large part by intercompany loans. And there is some great work by Indian journalists, really tracking the money flows inside the Adani conglomerate. And so we found these banks that were arranging bonds for Adani Ports. They said they wouldn't lend to Carmichael, so these were like Standard Chartered, Barclays, Deutsche Bank, JP Morgan, Citibank. But what they were doing was freeing up capital that could then flow to Carmichael. So they would say to us, no, these bonds are for specific things. We have a commitment, they're not going to leave India, they're for specific things. And we were saying that's fine, but that means other money that is not tied can then doesn't need to go to that specific thing, and Adani can use it for whatever it wants. So by helping Adani raise bonds, they were essentially indirectly funding the Carmichael project. So we did a round of letters, to these arrangers, but also to a whole bunch of the bond holders in Adani Ports and Special Economic Zone. And we got some good responses and commitments, and had two really big wins from that mobilization. We got PIMCO, which is owned by Allianz, which I think is the biggest specialist bond investor in the world, promised that they would not buy any more Adani Ports bonds. And there was an article in the Indian media saying that Deutsche Bank had pulled out of Adani Ports bond issues because of environmental concerns, and they haven't actually been involved in any Adani Ports bond issues since. So, we were able to get a result, but we continue to push. Recently, Stopadani has been focusing very strongly on BlackRock, which is a really big bondholder across the Adani group. And we're also finding that there's different sorts of bond markets as well. So, one, as some Adani entities like the coal port in Australia gets more and more unpopular, they're now moving into the US private placement bond market as opposed to the kind of public mainstream bond market. So we'll be chasing them down that avenue as well.
Okay, thanks. And what have been some of the challenges campaigning around the bond market compared to other types of corporate engagement that you've participated in?
Yeah, so one of the key issues we've found with running campaigns on the bond market is information and a lack of it. So that's been really key and difficult. So we use aggregate information services like Bloomberg to really find bond issues, look them up, find those lists of bondholders, how much they own, etc., and you can track the shifts over time. But the visibility for bond issues for Adani Group bond issues is quite low through those. We usually get about 20% visibility in terms of we find up to 20% of the ownership of the full bond issue. So that's been a real difficulty. And yeah, one of the things we've been working with. Another key question that I think is a really interesting one to continue to explore, we haven't come to a definitive answer, is there's kind of two main, apart from obviously the fossil fuel company issuing the bond, there's bond arrangers, which are those banks that I mentioned initially, which is how we got our attention onto the bond market in the first place. And then there's the investors themselves. Working on the investors, it's the more traditional divestment sort of campaign, but there's just a huge number of them. So there's less arrangers, but I guess the leverage there is different because they're not the ones actually, handing, and sometimes they are handing over some money as well, but often, the big companies putting the money in and not the companies that are arranging the bonds. So that question, where does the pressure need to be put if we have to choose one, arrangers or investors, I think is still an open one.
Okay, thank you. I've got a couple of questions, but we'll save them for the next section. I think first of all, we'll check in for the audience questions, specifically for Dongjae and Pablo, based on what they've just said. Are there audience questions for Pablo or Dongjae? Okay, so we've got one question's come in for Pablo from Susan. Are there private bonds like private equities? If yes, do private bonds have a large share of the market?
So yes, the answer is yes, but it's something we've quite recently kind of discovered and started looking into. So it's still early for us in terms of really getting our heads around the at least the United States private placement market, which is what it's called. In terms of the share of the bond market, I don't know the answer to that. But yes, so for example, the coal port, Adani's Australian coal port, which is called NQXT, that recently, in kind of middle of last year, refinanced a bond issue that was due in September last year with a US private placement bond issue. So that's essentially just a much more direct, the bond arranger approaching a group of bondholders and selling them the bonds directly without, putting it on the market or seeking more public bids.
Okay, thanks. And Christina, did you want to chip into that question as well?
Yeah, sure. I think that, so as Pablo has said, I think the private bond markets do exist. And I think because it's private, the research on private bond markets is challenging. These are bilateral arrangements, so it's very unlikely that it will be available to public. So, good luck to Pablo, in doing that research on the US private placement. But it's something that we are aware that, perhaps if public bonds get more pushback, if investors are pushing back on bonds that are issued by certain companies that are not aligned with the Paris Agreement, there is that chance that issuers will go to the private market, and that is a danger. But I think it also depends. I think private issuers or private bond issuers will need to have established some kind of debt profile. So, in the public market to be able to, secure a good subscription, I guess, in the private market. But, once bond issuers actually go to private market, their risk is also quite high, the risk and returns. So, it's kind of a trade-off for debt investors.
Okay, thanks, Christina. I had a question for Pablo. You touched on Adani and it being able to kind of move the capital that it raised through the corporate structure. What we've seen sort of a lot in the trend of ESG investing is the theme of both kind of targeting, specifically green projects and green companies, but also companies in transition. So, for example, fossil fuel companies that have policies in place to improve their practices. But so I suppose, speaking from your experience of Adani, is there a concern in this kind of transition financing trend of sustainable investing that money might not end up where it should, or in having the kind of influence it should, and how can you kind of mitigate for that risk?
Well, I mean, our argument is that you shouldn't be funding companies that are expanding fossil fuels, even if that funding is for something else. Because then that frees up capital that the company can funnel into fossil fuels. I mean, we get that message from some of these banks that we've spoken to. They say, oh no, we want to fund Adani because it's a company in transition. But it's not a company in transition because it's doubling its coal-fired power capacity, or plans to, and it's building several massive new thermal coal mines. So it is expanding into renewables too, but you can't be in transition if you're building new fossil fuel projects. So I guess that's really the point we make to these companies, is that it's all good to fund companies in transition, but they have to be actually in transition, not pretending to be in transition.
Okay, thank you. There's a question for Dong Jae now. You have published a blog on the Toxic Bonds website where you argue that KEPCO, the Korea Electric Power Corporation, that KEPCO's issuance of $8 billion in bonds in the first quarter of this year is a cause for concern. Why is that?
Yes, KEPCO's massive amount of bond issuance was carried out quite rapidly last quarter. Given KEPCO's market value of $11 billion, this amount of bond issuance almost reached KEPCO's whole capital. As you may know, KEPCO is the major coal company of Korea, and we presume this to grow into a much bigger problem in the near future. KEPCO owns the majority of Korea's coal power fleet, and up until last year, KEPCO has expanded its coal business, which includes notorious Java 9 and 10 in Indonesia and Vung 2 in Vietnam, which are all evaluated to bring massive loss to KEPCO. Even this time, raising electricity prices despite soaring fossil fuel prices played a factor. But it seems evident that KEPCO's huge coal assets will negatively impact the financial status and structure of KEPCO. If nothing is voiced against refinancing or reissuance of KEPCO's coal bonds, we worry that KEPCO will continuously compensate for their financial deficits from the coal assets. So that's the point I wanted to deliver.
Okay, thank you. So I think we'll now open it up to questions for all the panelists. So if any of the audience, the participants have questions for others, please feel free to feed them through. So the first one that's come in is what is the role of governments in regulating the bond market? Can they do more to make it harder for fossil fuel companies to issue bonds when they do not have concrete transition plans? And I think perhaps we can start with Christina. Pablo, I imagine you might want to feed into that one. Dongjae, Lara, feel free to take it after. Christina, over to you.
Yeah, I think the government, can do whatever they want. It's a question of whether they want to be, want to be interfering or to be seen to be interfering. I think. A lot of governments, they do take pride in, having a free market. And by that, what they mean is very little government intervention. And that's something that investors in general do appreciate when it comes to, and it is one of their investment decision making as well. It's how much does the government interfere? But I think in terms of tightening or strengthening regulations, it's definitely a possibility. I mean, I spoke about green taxonomies before. I think, some green taxonomies that we are seeing in the market definitely needs more clarity. And in the absence of clarity, I think what the government could do there is ensure that that the issuers are actually abiding by the green taxonomy. There should be proper checks and balances. That the criteria for issuing a green bond is met. So I think there are many ways that governments could be involved in the regulation, but the extent of what they do is questionable at this point in time.
Okay, thanks. Did anyone else? Yeah, go ahead, Pablo.
Yeah, just from a slightly different angle. I mean, in terms of government regulation, where that's best applied, I'd probably take a step back, because what we want from government is not necessarily fiddling with the bond market, but actually just refusing to approve new fossil fuel projects at kind of a broad, nation policy level, essentially banning new fossil fuel projects and then implementing just transitions, out of fossil fuels, at the nationwide level. And so I think, while that's probably where government policy would do the best work. And so while the climate movement pushes for that, we need to stop. We need to be working on the bond market to really force investors to stop putting money into these, these dirty companies that are building new renewables. But yeah, I'd like to see governments just say, we will refuse to approve new fossil fuel projects. And then there won't be any to invest in.
Okay, Lara, did you want to comment on that one?
Yeah, maybe just to add very quickly on this, I agree with what has been said. And what Christina was saying also about these green bonds or sustainability linked bonds is that today you can actually, not talking about classic bonds, but labeled bonds, you can actually issue one even if you were involved in fossil fuel expansion. So definitely a place where governments could start would be to regulate with more standards and making sure that's what being called transition or sustainable is really that. But also, since we are a bit far from this, this is also why in terms of campaigning, it's really important to also push for financial institutions and asset managers, in this case, to have the proper policies in place to commit themselves to not buying the bonds of fossil fuel expansionists. And this is something that some are starting to do, but that should be more widespread and maybe encouraged by governments in terms of maybe transparency requirements on their policies, and would be a good start.
Okay, Dongjae, would you like to come in?
Yeah, I'd like to add on to the point of Christina. Yeah, I really agree with the role of governments dealing with the bond. At this time, Korean governments retreated its will for 2015 net zero commitment by including LNG to the Korean taxonomy. So even if labeled as green bond in Korea, we can't follow up if there's invested in renewables or LNG projects. So I think that's what our next campaign should head it up to. And also for even if it's not the government agencies, but I wanted to highlight the role of credit rating agencies also are really important. But I think credit rating agencies should reflect substantial risk of coal assets they evaluate. When we are on the campaign stage with Samcheok Blue Power, we were quite surprised to see that Samcheok's ratings are evaluated as AA minus, even though the project's risks it has. So I think even in here, campaign's role is also important to persuade credit rating agencies to reflect the substantial risks of the coal bonds. So, yeah.
If I could just jump in there, Natasha,
Sure.
just to add on to Dongjae's remarks on credit ratings. That is something that we have seen in our own research as well. And it's not just Korea, it's I think that we have seen state-owned entities with strong government links. As a standalone, as an issuer standalone, it is actually just a junk bond rating. But because of the state back link, or the government's links to the government, that bond or that issuer can actually get significant uplift in the credit rating. We have seen some that go, 6 or 7 notches upgrade. So what would have been a junk bond automatically becomes an investment grade bond, just because of the ties to government. Now, so that is something to think about, like in terms of, how, credit rating agencies have got their methodologies, and it is transparent. It does reflect that if you are government linked, you have a strong case for financial backing. And that's why they have got that practice of pulling them up in investment grade. But it's something to think about, I think, for people in the market.
Okay, thanks all. So we've got another question from the audience. I think this is perhaps on the data front. Do we know that banks are increasingly unlikely to issue loans to companies? Who would like to take that?
I mean, I can jump in on that. Like, I think,
Sure.
I mean, I think we can see, I guess we can say that we've seen tentative steps. Like, I would hardly say that we're in a situation yet where coal, oil, or gas companies are frozen out of the lending market. But I think, and we're certainly a long way from that. But I think there are some tentative steps that, at least in some regions, banks and investors are, instituting coal exclusion policies, which, in general are not going far enough. But I think we are seeing some tentative steps. And I think, and if eventually banks and investors do align their lending or investment criteria to the Paris goals, then we'll have to see tighter conditions on those criteria. But I think the problem is, like, in general, what we see is that where these policies do exist, they are not applied in the same way to banks' underwriting activities, which they consider an off-balance sheet activity. So a bank may have a climate policy which is looks all right on paper, but that same policy doesn't apply necessarily to underwriting activities they take or kind of other bond market activities. And I think that's the big concern, that if the bond market isn't paid attention to, it could be sort of left as a bit of a carve out from any policies that are instituted going forward. So I guess I think given the bond market is intrinsically less transparent than other parts of the market, then I think that's the thing we need to be watching out for, and why it pays to be campaigning in this space.
Yeah. Okay. And you kind of touched on it there, that for years banks and asset owners have come under pressure from civil society and government to tighten their lending criteria and divest their portfolios, divest from portfolios that are polluting firms. Why hasn't the bond market, you've outlined sort of why it's important, but why hasn't it been the subject of widespread campaigning in the same way? What's different about it, and what gap specifically is a Toxic Bonds Initiative trying to fill here?
Yeah, well, I think, like, they've been touched on in various ways by almost everyone on this panel. Like, I think there are some big challenges here in this market that make it difficult, and the biggest one is that lack of transparency. It's the fact that, in general, the disclosure requirements on debt markets are just not as high as they are in equities and other markets. So I think there's a lack of transparency there, and an information gap that is challenging to overcome. So I think one of the key things that we in consulting with civil society organizations around this work, we determined that one of the most useful things that we could do was I guess, lay out for people where are the outstanding bonds of major emitting companies, and where are those, when are they coming up to maturity? Because that's the key moment, I think, that there is opportunities for campaigning and engagement. It's when a bond is reaching that maturity date and the company is going to refinance it. That gives an opportunity then for civil society engagement to go out to bondholders in the market and say, don't participate in the refinancing of this bond. There's a lot more, I guess, stability in planning, I guess, and engaging stakeholders when you have those kind of timelines, which you just don't have in terms of, like, primary new bond issuances.
Okay, Lara, did you want to come in on that question?
Yeah, maybe to add on this. I mean, Nick summarized this very well, but I think for campaigns in general and in the past on banks and investors, we had started with broad demands on all assets and types of financial services. And it's more that now it's also getting more focused on bonds for a few reasons that we already touched upon, like that's an increasing source of financing. There was a question on, are banks actually, are we actually seeing them giving less loans? And this is something that we see in our tracking of policies. So our coal policy tool, which is also present on the toxic bond website, we clearly see more and more policies that are starting to restrict loans going to coal, even if it's far from enough. And I think there's also another reason that it's important to be more and more focused on bond campaigning, is that there's now this whole engagement vs divestment debate that is taking more and more space in our sense, that is a bit hypocritical, because asset managers, investors could actually keep engaging companies with their existing investments, but commit to stop buying new debt. And this is not something that we're seeing them do. So it's really important to get this message out there that they can, if they really want to do credible engagement, they need first to have these red lines on buying new debt, for example. And yeah, that if we want to tackle and stop fossil fuel expansion, we really need to stop new bonds from being bought. But this I think all goes into the end goal of the campaigns, that is the same, is how do you stop money that is flowing to the companies behind the new fossil fuel projects.
Thanks, Lara. Would anyone else like to come in on that question? Okay, so we've got another from the audience, this time from Joel Morland. The speakers have mentioned investors in bonds, underwriters, deal arrangers, credit ratings agencies, central banks, regulators, and governments. Are there other bond market participants that campaigners should be targeting? And Pablo, I think that's perhaps one for you.
Yeah, I mean, that's a pretty comprehensive list. There's one recently actually that we've been looking into, which is security trustees. So that came about because the Bank of New York Mellon was outed as being the security trustee for this coal port I've mentioned a few times, NQXT. And then after the backlash that ensued, they said, we're resigning from our role, you know, goodbye. This is not part of our value system, etc. And so we started looking into security trustees, and you know, they have a role where they essentially hold the collateral on behalf of all the bondholders, you know, in case there's default or those sorts of things. And so, you know, an important role. And so we're focused at the moment. So the company that we believe has taken over from Bank of New York Mellon or will take over is called Glass, which is a London-based company. And so we've been engaging them as well. But yeah, that's just security trustees. Joel, you can add that to your list.
Okay, thanks. And I've got actually another one that I'll take the liberty of asking there. So you've talked about different market participants and actors to target, but have you also considered different products? So for example, rather than direct investing into bonds, what about, for example, fixed income funds and similar? Will you also be looking at specific products and the different mechanisms, potentially campaigning mechanisms around those?
Yeah, I can jump in there. Absolutely. I think the providers, I guess, who of this index, the indices providers are, I think, a very interesting target here that are worth paying more attention to. And I think there is, you know, quite, I guess, the potential for, you know, leveraged impact there if we're talking about getting certain companies knocked off various indexes, which of course has big flow-on effects for which fixed income funds then obviously track those indices. So I think there's some big opportunities there. And I know actually, Pablo, in the Stopadani campaign, there has been a little bit of work around targeting the indice providers, right?
Yeah, a little bit of work. Yes, we have, and mainly the work has been done like on MSCI and S&P, specifically on sustainability indexes and climate indexes at this point, to try to get them to really justify why certain companies are included. And you know, those inquiries have seen Adani Ports kicked off the Dow Jones Sustainability Index about 12 months ago, and kicked off 4 MSCI climate indexes at the end of last year. So it's worth making those queries, but yeah, you've got to have a strong case, I think.
Cool, thanks. Lara, did
And
you want to
maybe
comment on that?
Yeah, to add on this passive question, and I think that's a really important one. This is something that we also find out in our report when analyzing the policies of the asset managers, is that very often, even if they have pretty good, robust criteria on coal or oil and gas exclusions, very often they don't apply these exclusion criteria to other assets and the types of management. And for example, in most cases, the funds that they manage passively, so tracking indexes, are just not covered by the policies, or with only like a very little number of funds that are climate funds, for example. So this is a really important aspect, and we actually are not seeing asset managers really engaging index providers, telling them, now we really have these coal exclusion criteria that we want to implement, and we're actually still investing and involved in coal expansion, mainly because of their indexes. So they actually do have the power to either change the indexes that are within the funds, or put pressure on the index providers to ask, like, why is this company still included in the index?
Okay, thanks. I think there's time for one last question, so perhaps we'll kind of take a sort of stand back and nod to the future. And this is one for all the panelists, I guess. What are the big opportunities that you see ahead, as well as the challenges you foresee in trying to shift such a market in this initiative? Nick, maybe you can start with that one.
Sure. I mean, look, ahead, I think I just see only opportunities, really. I mean, I think, as we've just talked about in this conversation, there are so many avenues to pursue in this in this field. I think there are so many potential targets and so many areas of impact. I think what I'm most excited for over the coming 12 months, at least, is to really dig down deep and try and focus on the refinancing of a couple of key bonds on the horizon. So we're looking at some of the big kind of the well-known companies, Adani, KEPCO, and others, and to try and try and hone in, I guess, and use any of those maturity dates that are on the horizon for those companies to engage bondholders and try and secure commitments from investors to pay attention to their fixed income portfolios and commit commit to deny debt to expansionary fossil fuel companies. So I think it's there's a heap, and I think there's a whole heap of like potential work to be done on some of the more interesting targets here, like credit ratings agencies and providers of second party opinions, and the index providers. There's a whole stack of opportunities here, and I'm really excited to get to work on it.
Great. Dongjay, Lara, Pablo.
Yeah, I can jump in on this. So I agree with Nick that there's exciting campaigning activities and also learning on this to be done. I think one of the things that's exciting is that investors, even if they do have power via the shares that they own, and we see this because we're in the middle of the AGM season and they can have influence on companies by their voting, but we can't just ignore like this huge leverage tool that they have with the bonds investing that they're doing, that it's a critical moment for them to try to influence a company's transition process. So it will be really important to have these have this influence be effective and very focused on important aspects of the transition. For example, really stopping the fossil fuel expansion, the opening of new oil and gas fields, and really having these red lines drawn by the financial institutions.
Thanks, Lara. Dongjay.
I will say KEPCO bonds, as lots of bond of KEPCO faces a mature date this year, and also there could be additional bond issuance in the near future. In the campaign perspective, I think KEPCO is really easy to tackle with if we consider that they're still operating and constructing lots of coal power project in the overseas of Korea, and also they are still operating a lot of coal assets in Korea, and they haven't suggested any roadmap to phase down the coal assets of them. So I think that's kind of low-hanging fruit for asset managers to deal with, and also for the campaigners to deal with the Capco's new bond issuances. Thanks.
Pablo?
Yeah, I mean, you look, the bond market is where the money's going at the moment. And so obviously it's absolutely critical that the climate movement and civil society is there holding these companies to account that are fueling the climate crisis, investing in the climate crisis, and, in the fires and the floods and the heat waves that it's fueling. So it's critical. And, sometimes it does feel like we're playing that whack-a-mole game, like we stop a project from getting bank loans and then it goes off to the bond market. Then we stop it from getting bonds and then it goes to the private placement market. But I think the important thing to keep in mind is that each avenue that's closed off, it does get harder, and harder for these companies. And so really important, I think, to just keep it up, be relentless, and follow the money as much as we can.
Great, thanks very much all. So, I think we've heard today that bond markets are clearly in a really important corner of the economy that continues to channel funds to fossil fuel firms, particularly with these expansionist plans and this is despite warnings from the International Energy Agency, the UN Intergovernmental Panel on Climate Change, about what we need to do collectively to contain global warming to a safe level. It's been really interesting to hear lessons from specific campaigns to date from both Dongjae and Pablo. Really look forward to seeing how this important work will evolve, how the Toxic Bonds Initiative will develop, particularly relating to the different stakeholders we've mentioned and the different products that we've touched on. Just wanted to say thank you to all our panelists, to our hosts, and of course to you, the audience. And I'll now hand over to Nick to wrap up.
Thanks, Natasha. And can I just pay an enormous thank you, particularly to you, for the excellent job you've done moderating today and bringing all your insights from reporting in this field to this conversation. It's added a huge amount of value to these discussions, I think. And I want to say thank you also to all of the panelists for giving up their time and for offering their insights here. And of course, to the audience, everyone of you who has joined in today. It's been fantastic to have your questions and have your participation. And if you'd like to be involved more, I mean, this initiative is really at the ground floor. We're just launching this week, and it's with the launch of the Dirty 30 list, we have our kind of target list of companies we're going to be investigating. On our website, you'll be able to see all the outstanding euro and US dollar bonds those companies have issued. And if you pay attention there over the coming weeks and months, you'll see some campaign launches that are ahead that we'll be working on based off this. So if you'd like to be a part of this network of organizations who are interested in working around the bond markets, please get in touch. Follow us on Twitter or on LinkedIn. Before we sign off, thank you again for joining, and have a great day.